Okay, so good afternoon. I was asked to talk about the alternative to borrower-based measures in mitigating risk from real estate markets by using the Belgian experience. So the usual disclaimer applies. What I say does not necessarily represent the views of the National Bank of Belgium. I will start with some facts about the Belgian mortgage market, which I think will help to understand why we took the measures that we took and in what consists the additional measure that we are now proposing So the measures that we have taken is for the IRB banks, but we also took some soft measures starting from 2012. So for the facts on the Belgian mortgage market, this chart shows you the indebtedness of the Belgian household sector. There has been a trend increase for over a long time. It is growing about 1%, 1.5% per GDP per year. And we reached the euro area average in 2015. It is now slightly above 2016. But the Belgian households are quite rich in terms of financial assets. And there, this is the right-hand chart. When we do the debt ratio relative to financial assets, the position is still much more favorable than the euro area average. So we have a mortgage debt of around 200 billion in Belgium, and the financial assets are around 1,000 billion. These financial assets are, of course, mostly concentrated in the richest households, which also have a high income. So this chart is a little bit difficult to read, but it is based on the Household Finance and Consumption Survey. And it shows that within this household debt, there are pockets of risk. And that is the main reason why we took the macroprudential measures. So the chart shows you the distribution of the mortgage debt in Belgium and in the euro area. The red colors is the debt where the debt service to income ratio at origin is higher than 50%. And you move to the right with lower ratios for the debt service to income. The shaded areas are the mortgages for which the household has financial assets which are less than 6 months to reimburse the debt service. So they combine a high debt service with low financial assets. And you see that this shaded area in red is higher than in the case of the euro area. In part that is due because in Belgium all the mortgage loans are amortizing. It's typically annuity, so the debt service includes not only interest payments but also capital repayments. But nevertheless, this is a source of vulnerability for these households. If there is an income shock, they might quickly come into difficulty. So this chart shows you the results of a questionnaire that we launched in 2012 and which we do now every 6 months in order to gather information on the credit standards for Belgian mortgages. This is about the maturities at origination, so it is the maturity applied to the loan when it is given by the bank. And on the right-hand side you have the vintage, so you have the data by production year. In 2012, we gave a stern warning to the supervisor in Belgium, which we were ourselves, but also to the banking sector, that more vigilance was needed about the credit standards. And you see, in fact, that in terms of maturity, that the banking sector has really tightened a lot these credit standards. The share of mortgage loans which have an initial maturity higher than 25 years, which represented 20% of the production in 2012, it no longer exists anymore. Knowing that almost all loans are amortizing, this means that all other things being equal, the debt service ratios should have gone up because you need to repay all the capital in a shorter time of period. I will show you that in fact these debt service ratios have not increased, and this has shown up as well in a decline in the PDs. So in fact, in terms of probability of default, there has been an improvement since 2012. So this warning was a first strong message, I think, that we gave to the sector. This was, of course, a soft measure. We also asked the banks to do a self-assessment of the EBA standards on sound practices in mortgage lending. And then we followed this up with the first macro-prudential measure, to which I will come back at the end of the presentation. So here, clear evidence of a tightening of credit standards since 2012. This gives you some more information about the interest rate variability in Belgium. So most of the production, you see that on the right-hand side in red, is fixed rate, so for the whole maturity. So if a loan is given for 20 years, most of the time this rate will be fixed for 20 years in Belgium. And the option to refinance is very cheap. You only need to pay 3 months of interest on the outstanding capital and you can refinance your loan. And you see in these blue bars on the left-hand side that there has been really a refinancing wave in the last years, which also has reduced, of course, the debt service ratios for the households and reduced the probability of default because they have locked in a fixed interest rate at a much lower level. Of course, this implies more risks in terms of ALM for the banks, interest rate risk management, but for the households, the interest rate risk is quite limited. Then if we look at these debt service ratios, so I've explained the maturities have declined, so all other things being equal, we would have expected a deterioration in these standards. What we see is, in fact, on the right-hand side, the opposite, an improvement. Part of it is related to the refinancing that I have just shown, so the debt service ratios have been lowered after the refinancing. But it remains that in Belgium, and that has a lot to do with these annuities, you repay a lot of capital as well. The debt service ratios remain quite high in terms structurally. So the largest share of households combines at origination a debt service ratio between 30 and 50% of disposable income. And a non-negligible share also has a debt service ratio higher than 50%. Then for the loan-to-value ratios, there the improvement is less important, and that is the main reason why we have now proposed to extend our macroprudential measure, to which I will come back immediately. You see that in terms of new production, a quite high share of new loans is still associated with an LTV higher than 90% at origination. This has partly to do with the very high stamp duty in Belgium. So it is around 15% of the value of the transaction. So if you buy a house, you need own funds, equity of 15% of the value of the house just to pay the stamp duty and the notary fees. And then you can only get to the equity that you need in order to reduce your LTV. So this is partly the reflection of the structural feature. I do not defend this, but it is something which helps to explain why a lot of households need a quite high LTV at origination when they come to the property market. So summarizing these three credit standards in the terms of stock, this is done in this chart. So on the x-axis you have the debt service ratio at origination. In the y-axis you have the LTV at origination, and the colors in the circles are the maturity at origination. And so what is of interest, I think, are these subsegments of loans in the outstanding stock, which combine a high level of LTV, debt service, and or maturity. And this chart, I think, was the most convincing chart for our executive board of directors to see the need for a measure that covers the stock of loans. So we took a macro-prudential measure which affects the stocks of loans and which is mainly focused on strengthening the resilience of the banking sector. In terms of indexed LTV, you have the left-hand chart. So there is about 30% of the outstanding stock now, which has an indexed LTV higher than 80%. The capital is reducing because all our loans are amortizing, and the house prices have increased for quite a sizable amount of the stock since origination. And on the right-hand chart, you have the confirmation that more than 96% of our loans have an annuity repayment schedule. Then here is this point about the PD risk. So on the left-hand side, you have by vintage of production the default rate on the mortgages. And you see that the worst default profiles were in 2006, 2007, 2008. And that the most recent production vintages have been associated with a much more favorable default experience. On the right-hand chart, you have the cure rate. So even if a loan falls into default, more than 90% of these loans become regular again. You see that it has become somewhat more difficult with the most recent vintages to get them regular again. I think that has to do with the fact that, in fact, in real terms, house prices have no longer risen over the last 4 or 5 years in Belgium. So it's easier for a bank to be easy with the payment problem when the value of the house has increased. But nevertheless, in terms of credit losses, the Belgian mortgage loans, they are associated with 5 or 10 basis points maximum of credit losses for the banking system, which is really very, very low. Of course, we need to keep it like that, and that is why preemptively I think we have taken these step-by-step measures to avoid a further build-up of the household debt and especially a further increase in these risky subsegments in the outstanding stock. So what have we done? So in 2013, we implemented for the banks using an internal risk-based model for the Belgian mortgage loan, a 5% add-on to the risk weight. So for every individual loan, a risk weight can be 2%, 4%, 6%, 10%, 12%, 30%, 40%. We add 5% to every individual loan in the outstanding stock. And in fact, this is exactly what would be a sectoral CCYB of 5%. We cover the whole stock, so the whole stock is covered, and every loan has a systemic risk buffer, capital buffer in addition. Given this continuous trend in the upward trend in the household indebtedness, we decided last year to extend this measure. So we have now proposed a new measure for the IRB banks, which will be composed of 2 components. The first one is the same as the existing, the 5% risk weight add-on on the IRB risk weight for Belgian mortgages. And we will ask of the banks to calculate an additional macroprudential capital buffer for the loans with an indexed LTV higher than 80%. And how do they calculate this? They use their macroprudential calculations, and they replace the LGD by LGD floors of 20% for the loans with an indexed LTV higher than 80, and a LGD floor higher than 30% for the indexed LTV higher than 90. The extra capital buffer is sizable, 600 million. The first one was 800 million, but is certainly not huge. And so we do not think that this will have really a very prohibitive impact on the market, but it further strengthens the resilience of the banking system, and it will also contribute to a better pricing of these high-risk loans when they are granted to the more new debtors. Thank you for your attention.